Weekly Gold Price Analysis, June 17 through 22, 2025. Focus: Geopolitical and economic drivers behind US-Iran conflict. Acknowledged. I will analyze gold price movements for this week with a focus on geopolitical tensions, particularly the U.S. military intervention in Iran and key macroeconomic signals. I will also include insights from major financial sources such as Bloomberg, Reuters, and gold market analysts. Gold gains on safe haven demand amid Middle East crisis. During the week of June 17 through 22, 2025, gold prices experienced significant volatility. The metal surged early in the week as investors sought safe haven assets amid rising geopolitical tensions in the Middle East. However, later in the week, gold softened slightly as geopolitical risks eased marginally, and the U.S. Federal Reserve signaled a tighter monetary stance. Key geopolitical drivers. Geopolitical instability in the Middle East dominated market sentiment this week, pushing investors towards safe assets. Key events included: June 12, Israel launched airstrikes targeting Iran's nuclear facilities, triggering panic buying of gold. Spot gold spiked 1.8% as fears of a wider regional war grew. June 16, gold retreated over 1% after hitting its 8-week high, as profit-taking occurred despite ongoing air conflict between Israel and Iran. June 17, President Donald Trump stated he wants a real end to Iran's nuclear threat and hinted at potential diplomatic talks even as airstrikes continued for the 5th straight day. This helped sustain gold as a safe haven. June 19, the Federal Reserve held rates steady but signaled a slower pace of cuts due to persistent inflation, which pressured gold. President Trump also toned down earlier military threats, opting to explore diplomacy first, easing some geopolitical risk and cooling safe haven demand. June 21st, the U.S. launched a surprise joint strike with Israel on Iran's nuclear sites. Trump declared a stunning military victory, saying Iran's nuclear infrastructure was wiped out. Iran responded by vowing painful retaliation. This shocked global markets and is expected to spark equity sell-offs and further inflows into gold and oil at the start of next week. Oil prices and global financial market impact. The Middle East escalation had immediate spillover effects on oil and financial markets. Brent crude surged 18%, reaching nearly $79 per barrel, its highest in nearly 5 months. Analysts warn that if Iran retaliates by blocking the Strait of Hormuz or attacking energy infrastructure, oil could jump to $100 per barrel. Markets expect oil to gap up $3 to $5 per barrel on Monday due to rising geopolitical risk premiums. Global equity markets, particularly the S&P 500, initially dropped on war news, but later stabilized. History suggests Middle East conflicts cause short-term dips, but stocks often recover within months. E.g. in Iraq War, 2003, Saudi oil attack, 2019. Safe haven assets like gold, U.S. Treasuries, and the dollar are expected to benefit from investor caution once markets reopen. However, the magnitude of Iran's retaliation and oil price trends will be key in determining broader market reactions. Rising oil could fuel inflation, complicating the Fed's rate policy outlook. Gold price movements and short-term outlook. Gold prices were highly sensitive to geopolitical developments this week, spiked to a 2-month high of $3,400 per ounce early in the week due to war fears, dropped by over 1% on June 16 as traders took profits, stabilized midweek near highs but was facing pressure from the Fed's hawkish tone, ended the week around $3,370 per ounce, down 1.8% from the previous week, marking the first weekly decrease in 3 weeks. Despite short-term pullbacks, long-term demand remains strong, particularly from central banks and institutional investors seeking to hedge against systemic risks. Near-term outlook. Gold's trajectory will hinge on how the US-Iran conflict unfolds. If conflict escalates, gold may rally further on safe haven demand. If peace talks emerge, gold could face further profit-taking and retrace toward technical support around $3,250 per ounce. Regardless, analysts note that dips are often met with strong buying as the broader uptrend remains intact due to ongoing geopolitical and economic uncertainties. And hey, if you like your global news fast, clear, and a little spicy, hit that subscribe button. I've got you covered every single day.